Welcome to this class in which we want to distinguish financial and management accounting, just to see what the two sides of accounting do and what are their differences. First of all, let's look at what accounting is. Here's a very complex definition of accounting. It's the concepts and procedures. Well, accounting is a process using set of procedures to collect, record, present financial data for a particular organization for the purpose of describing and analyzing the financial position and performance of the organization, and as a means of facilitating decision making. That is one incredibly long sentence. It is complex. It is full of meaning. Let's separate out some of the main points. Okay, as you can see, I've blotted in some of them here in red for special attention. Say, accounting is a process, for example. We'll look at what that means in a second. Using a set of procedures, we'll look at that, and so on. So we'll go through each one of these and see what they mean. First of all, it uses the following words. It uses the words process. This means that the accounting activity is continuous. It just doesn't happen on a particular day and stop. It is a continuous process. It has a set of procedures. It uses rules and conventions as set down by accountancy professional bodies, so as to ensure consistency over time and between companies, between firms. So the rules for accountancy are understood and standardized. It collects and records and presents financial data. In doing this, the accountants must adhere to standards and to be honest and open about their findings. The data relates to costs, sales, purchases, and is recorded using double entry bookkeeping. That's a particular way of doing accounts. So everything must be open and honest, and it collects and presents real data, actual data, which has not been manipulated or distorted in any way. That would be dishonest. And then it describes and analyzes. Well, once the accounts have been published, it's assumed that they are honest and accurate. This being the case, they describe the firm's financial position and enable its financial performance to be analysed and compared with other firms' performances in similar markets. This is how we judge how companies perform, if they're doing well or not doing well. And of course, all of that depends on the honesty and the accuracy of the figures that are presented. Now, the definition suggests that accountancy provides two functions. First of all, it presents a true and fair view of the firm's operations. A true and fair view. Those are important words in accountancy. It has to be true and fair. So in other words, everything must be completely honest and open. This is concerned with a branch of accountancy known as financial accounting. The data collected and recorded may be analysed and used to measure the efficiency and the effectiveness of firms. It can also be used for decision making, and this is sometimes known as management accounting. So there are two branches, financial and management accountancy. So first of all, let's look at financial accounting. This branch of accounting is concerned with presenting a true and fair view of the firm's trading position to external interested parties. There's that term again, true and fair view. A true and fair view of the firm's financial trading position. Must be honest, must be open. The external parties here could be the shareholders. They need to know what the truth is. They need to know what's happening. The government, well, the government imposes taxes, corporation taxes and so on. So it needs to know what is true and fair. And others may be interested, for example, financial analysts, banks, all sorts of other people may be interested in how the company is doing. Sometimes known as stewardship accounting. So the term we need to bear in mind here is that it is the medium through which the managers of the firm account to the owners, the shareholders. The accounts show how the firm is doing. And it only does this if it is a true and fair view. Okay, I think I've emphasized true and fair view sufficiently. Some possible interested parties in the financial performance of a business, well, the employees and their trade unions. Obviously the workers want to know how the company is doing. Their livelihoods depend on it. The banks, other lenders, they need to know if the company is doing okay. Customers, concerned about the security of supply. Suppliers and their credit arrangements. Perhaps companies supplying raw materials to the firm. They want to know that the firm is performing satisfactorily, generating enough profit to pay them and to enable them to continue trading. The government's statisticians want to know the nature of the business and the size of the business, and of course the taxation authorities have an obvious interest in the firm. They want to get tax revenue for the government. But also regulatory agencies are interested to ensure that the business is correctly run. It's not fraudulent in its dealings with its customers and suppliers. It's not cheating anybody. Other ones would be potential investors, people who are thinking of investing in the business. They need to know how the business is doing, and it picks up, or they pick up this information from the accounts, from the published accounts, which, going back to it yet again, must be a true and fair view of the business. It must be honest, it must be open, and the figures must be accurate, and it must be done professionally, and it must adhere to the standards set down by the accountancy bodies. So it's standardized. It's possible for potential investors to make accurate decisions, reasonable decisions based on the information. Of course, rival companies will also want to know how they're doing. They want to measure their performance against their rivals. And you do that by comparing the two balance sheets, the accounts of one company with the accounts of the other company. That's of course if they can get the information. Private companies don't have to publish it, just public companies. And lastly, thereabouts, the general public. We need to know how the companies are doing. We need to know how much profits they're making and how they're spending those profits, and investment in the future, innovation, and also that the products have got good quality, they're reliable, and they're not dangerous. The example I give here in the notes is pharmaceutical products. They must be tested accurately. We must have an insight into the company, and we get that initially at least through the accounts and the way the money that's generated, the profits that's generated, and the items of expenditure are dispersed, how they're spent. But also, I suppose the accounts throw up things like, are the company overcharging for the product? Is it fair that if we as consumers need this product, we need it for medical reasons, that we should be charged some very high price and the company gets very rich as a consequence. Would it be better if they charge less? Maybe that's an ethical question, maybe it's a political question, maybe it's not appropriate for this forum, but it's the way we think and the way we look at accounts. Also, of course, some people might be interested in buying shares in the company. And again, we need to know that the company, how the company is doing, and we need to be able to look into the accounts, which, dare I say, must be a true and fair view of the business. Right, let's summarize this bit. Well, when we look at the accounts for a company, we have essentially 4 different types: a trading account, a profit and loss account, a balance sheet, and a cash flow statement. And we'll be looking at those in different videos throughout the course. But for the moment, those are the sources of information that we could look at to try and get an insight into the financial well-being or otherwise of the company. All the data, of course, collected are historic. They were picked up at a particular moment in time, analysed and published. That, of course, takes time. So what it is a picture shot of the business at one moment in time. What's happening right now, the contemporary view, well, we don't really know. We assume it'll be similar to the accounts we're looking at. And it's always useful, I suppose, to compare accounts over time periods to see how they change. And the way the accounts change may be a reflection of the management and what the management want to spend money on and what products they want to develop, which markets they want to go into, and so on. They must be accurate, they must be honest and open, they must be reliable. And they're drawn up with standard procedures which are set out for all companies, and all accountants, professional accountants, will abide by the rules set down by their professional association. So that looking at one set of accounts for a business, business A, they will be drawn up on the same basis as for business B. So we have comparability in looking at the 2 sets of accounts. Now let's move on to management accounting. Well, this is really internal to the organisation. This is not external. This is not the financial accounts that are going to be published. These are accounts within the business to help management make decisions. They're essentially concerned with control and decision making, costs, apportioning costs, looking at budgets, budgetary procedures, looking at the internal management of the business, I suppose really from a financial perspective. Management accounting facilitates decision making through the provision of information and the analysis of performance data. So it is a big management tool, a big management activity. The data may relate to the past and include estimates of future performance, but these are done in a scientific or in a quasi-scientific manner. The accountants put them forward as suggestions of what's likely to happen based on historic data. You can analyse the costs of different departments, the costs of particular products, the most efficient levels of stock holding, and so on and so on. So it's a decision-making tool. More specifically, its management accounting deals with costs of production. It classifies and calculates the costs of production. This enables management to more accurately set selling price for the product. Once you know what the cost of the good is, the true cost of the good is, allowing for overheads and raw materials, machines, depreciation and so on, once you know that, then you know how much markup you need to add on in order to generate the profit. If you sell it less, you're not going to cover costs. The business will be in trouble. Calculating the cost of the product can be a complicated procedure, not only because direct costs have to be taken into account, but also, as I said, the overheads, the depreciation, the cost of the utilities, electricity, gas, the costs of the office, the costs of marketing, the costs of... These all have to be broken down and assigned to the products to work out the actual price. So how much does a company's telephone and communication system, and how should it be apportioned to each given product? If you make lots of products, how much of the telephone bill should be included in the price of one of the products in particular? It has to be worked out, it has to be calculated. Cost accounts deals with this type of question and provides management with accurate costings that relate to the company's costs. Now, I say accurate costings, well, as accurate as can be. I guess like all areas in life, mistakes can happen, or the procedures may not be followed completely, or errors can creep in. But as far as possible, professional management accountants, adhering to their own principles, and they're highly intelligent and very highly qualified people, they will work out what the precise costings are. And they're better at doing this than perhaps general management. So, management accounting is concerned with the following functions. It monitors efficiency within the organization and makes recommendations to management over any improvements it sees. It compiles budgets. This enables management to effectively control the business. It knows what the budgets are. So we have two types of accountancy. We have financial accountancy, which is to do with published accounts. This goes into the public domain if it's a public company. We can all look at the accounts and see how it's spending its money and how much money it's making, and there have to be true and fair views of the business. And there are different parties who are interested in the financial accounts. Then we have the internal accountancy of management accountancy, and management accountancy works out the budgets for each department, for each product, for each activity, whatever, and it tries to work out the true price of the product that should be charged in the market so as to cover all the costs, including some element of profit, and it enables management to make more effective decisions, and it's a better control mechanism. So we have two types of accountancy. This concludes this talk on the separation of the two types of accountancy, management and financial. Thank you for watching.